Well, hello everyone and welcome to my presentation. We're going to go over some trade setups with Fibonacci ratios, and I'm going to show you a little bit about how I combine these harmonic patterns with classical technical analysis. I'm Leslie Jouflas of Trading Live Online, and I'd like to thank Timing Research and TradeOutLoud for inviting me back for this presentation. I have a couple of books out. One is Trade What You See, How to Profit from Pattern Recognition that I wrote with Larry Pesavento, and also Essentials of Trading. It's not what you think, it's how you think. Now, unfortunately, due to kind of circumstances beyond certainly my control, and a lot of authors that had some books literally destroyed several years ago, this book is not available in publication any longer as a hard copy. However, I do provide it to any traders that purchase and are studying any courses from my website. This is my website, Trading Live Online. And here's my email address, and I'd love to hear from you any comments or questions that I can answer. So today, again, we're going to be looking at a little bit of the history of Fibonacci ratios and some proportion and symmetry, things to be keeping in mind. And we want to also be taking a look at some structures of the trading patterns that we can apply Fibonacci ratios to help us with those structures. So we're going to be going through a couple of those, and then we're going to go to some charts and try to put it all together and look at some examples. So Pythagoras, who lived from about 570 to 495 BC, was considered to be the father of modern geometry, and he and his students believed that the numbers in proportion were harmonic. We're going to look at what harmonic means on the price charts to us today, and that everything was related through mathematics. Now, unfortunately, the mathematical systems they had at that time were not advanced enough to be able to prove those theories. But Leonardo de Pisa, who lived in the 12th century, he was an Italian mathematician. Now, he was never referred to as Fibonacci. His name was not Fibonacci. He was given that name after his death. It's not exactly known when, but it could have been by Lucas, the French mathematician, and he had rediscovered Fibonacci sequence in the late 19th century, and he may have been the one that attributed that nickname of Fibonacci to him. But Fibonacci ratios kind of evolved from solving a problem. I believe it was a Spanish king that wanted to know how many rabbits would be produced in 1 year's time if you started with 2 rabbits. Well, I'll give you an example of the Fibonacci ratio sequence, and then you guys might be able to figure this out on your own. But Leonardo de Pisa had published his book, Liber Abaci, the book of calculations, and really what it gave us was a different use of mathematics of numbers. So he introduced the numbers that we use, 1 2 3 4 5 6 7 8 9 10, etc., versus Roman numerals. As you can imagine, the Roman numerals were rather limited. So let's fast forward a little bit to the Fibonacci sequence. And, what is it? Well, it's the sum of two preceding numbers. So if you start with 0, and 0 plus 1 equals 1, and then you take the next number and add it to the number right behind it. So 1 plus 1 equals 2. 2 plus 1 equals 3, 3 plus 2 equals 5, 5 plus 3 equals 8, and so on, all the way into infinity. And what is really interesting, where it gets really interesting, is that you can, let me go to the next slide here. after the 8 sequence of that, you can take any two numbers and divide the smaller number into the larger number, and that will produce the 0.618. And so here's a couple of examples of that. And you can, again, you go back to the sequence I had on the slide, or you can write it out if you like, and play around with it. And conversely, if you divide the larger number into the smaller number, you're going to get the 1.618 ratio. Now, these ratios are very common ratios, not only used as retracement ratio and an extension ratio, but also in adding structure to some of the trading patterns that I'm going to show you today. Now, the proportion is important, and this gets important with these ratios as a trading pattern for the symmetry, the harmonics, and again the proportion of the pattern. Now, the proportions, these go way back, and examples of the proportions using the golden mean can be seen in artwork, in architecture, and in nature, actually, all around us. But here's just a simple illustration of that, where the A to the B represents the whole, and then the ratio of AB to AC is going to be the same as the ratio of AC to CB. So let's look at a few more things on this. And here's the proportions of that. So try and keep this in mind. Maybe if you have a piece of paper, maybe just sort of jot this down, and then let's take a look at a couple of examples. So the painting by Leonardo da Vinci, The Last Supper, very famous painting. I think everyone's probably seen this, if not in person, in books somewhere. This is an example of those proportions and symmetry. So if we have the A to B that represents the whole, then the ratio of the AB to AC is going to be the same as the ratio of AC to CB. So we can further outline that in this painting. So here's those ratios, and we can divide this painting by using those ratios. Let me go back again. There we go. So this is a very proportioned, very harmonic, symmetrical painting, and many artists used, whether they were aware of it, I believe a lot were aware of the Fibonacci ratios and sequence, and conscientiously used it in their work. A lot of the architecture, the ancient architecture, have these ratios applied to them. So they were not a secret. And I think even a lot of artists that maybe didn't know the sequence, but I think just intuitively, their paintings would come out with that proportion and symmetry. It seems to be something that we seem to recognize when we see it. We may not know what it is, but it's something that gives us a pleasing feeling. And in nature, a lot of plants, flowers, their growth patterns are based on these sequences. If you even hold your arm out and go from the tip of your middle finger to your wrist to your elbow, you'll see those ratios that we just talked about. All right, so even the pyramids have those ratios. Let's see if I can click all these things on. I probably should have put those lines on to go a little bit faster. These are kind of slow. Looks like I knocked out some of the people on the bottom of the picture. But here's those proportions again. And even in music, we can find the Fibonacci series. We won't go into a lot of detail with this, but again, here's the proportions over here. You can take a, screenshot if you like of this and study this later, but the musical scales are based on the Fibonacci numbers, and again we see the instruments and how they're built, etc. So these are things that are not just hocus pocus, as a lot of people might have you think. They're used in some very reliable applications, and one is in science. I know somebody, a trader that I worked with many years ago, worked for NASA and had told me that one of the huge lenses for the Hubble telescope was based on Fibonacci ratios, and the 1.618 was, and the 0.618 were key ratios that were used to build that. Another way that we can use the Fibonacci ratios is in the financial markets. These show up on a repetitive basis in the price charts that we're looking at. So the harmonics, when I use the term harmonic, I'm referring to repetitive types of swings. These are swings that are very close to equal in length, and also in the slope and angle. So we can see here, even though this particular swing looks like it had a little bit more momentum to the upside, it's actually quite symmetrical to this swing. Just ended up extending a little bit more. And here we can see this swing. So what I did was I just took the length from low to high, I drew a line, and then I cloned that same line over to these swings. So we can see and compare the slopes and angles of these. And same with the down swings. So if you study some of the charts on different time frames, that maybe markets that you trade, you can go in and, as an exercise, you can just go in and map out these swings. Now sometimes you'll get like this swing, the low to high. This is not quite as long as what we see here, but it's related by a Fibonacci ratio. This ratio looks to be about the 0.786 retracement from this high to low. So the markets are always in a process of expanding or contracting. And there's only three trends that the market has: up, down, and sideways. So once you start to understand that, you can put a lot of the price action and the market environments into particular context, and then you can apply different trading tactics within those different contexts. So the Fibonacci ratios that I use on my chart are this. And this is what I've had on for about forever and a year. The 382, 0.50, 0.618, 0.786, 0.886. It just says 1.0. That's where the start of the swing is. Now for the extension ratios, meaning we're taking this length and multiplying it by 1.27 or 1.618, that's added to this low, and that gives us where these Fibonacci extensions are. We also have the 0.707 ratio, which is between the 618 and the 786. Now, I just don't keep it on my chart because it doesn't appear as frequently as these other ratios do. So, but I know it's there and I'm aware of that. So guess what? Up here, there's also another extension ratio, and that's the 1.414, and that's between the 127 and the 1618. So same thing, I don't keep it on my Fibonacci ladder, but I'm aware that it is there. Now there are other, many other Fibonacci ratios that can be applied in trading. However, I think what you need to consider is the frequency of which ratios are repeating the most often. Those, in my opinion, are the ones that you want to have on your charts. Okay, so let's take a look at one of these ratios, and that's what I call the 0.886, the last chance fib level. And this is the square root of the 0.786. Now, a lot of traders, I would venture to say the majority of traders use the 0.786. And then there's all this space to the 1.0, and without having knowledge of this 0.886. However, the reason I call this the last chance fib ratio is because oftentimes if price exceeds that 786, then it will come down and find support at that 886 and rally off of that level. Whereas traders that are using this level is maybe, let's say they went long at a 618 or something. That's just a very hypothetical example. I don't use fib ratios in that way, but just as a hypothetical example, let's say a trader went long at a 0.618 retracement and they put a stop just below the 0.786 as their risk without any awareness of this ratio. And so the market comes down, they're tagged out, stopped out, and then the market hits the 886 and then rallies back to the upside. So it will be to your benefit to probably add this onto your Fibonacci ladder and study it and do some observations of what happens when price, reaches a 0.886 retracement. Now, I've observed over the years that, prices often will rally if it's, a declining market, a declining swing, or if it's the opposite direction, it'll find resistance at an 886. But there's something else that I've noticed with this ratio is when the market starts getting closes below this ratio, then the price very often will head to that 1.0, and often once that's exceeded, then the 127 becomes the next level to keep an eye on, probably the next level the price is moving toward. Okay, so let's take a look at the structure of some trading patterns where Fibonacci ratios can help us with the structure. Now, the Fibonacci ratios don't necessarily form these structures, but they can use to help us identify validating or invalidating a particular pattern. So these swings here, these are called A, B, C, D. This is a sell pattern on the left, a buy pattern on the right. And there's different variations of this pattern, such as the Gartley pattern. Maybe some of you have heard of that one. The butterfly pattern also. Now, Larry Passavano was the trader way back when that he's the one that put the Fibonacci ratios as a way to identify the retracements and extensions of the pattern. So this was not done, that was not done by anybody else. That was Larry Passavano that did that. So the structure had been around for a long time. It's inherent in markets and price action, but he was the one that added the fib ratios to this. So let's look at the structure. So first of all, look at this and see that it forms like a lightning bolt structure. So we can think of that as a lightning bolt. So you have a swing up, then you have a retracement, and then the next swing starts the same direction as the first swing. And the D 1.0, this is where the AB leg and the CD leg are equal in length. The D 1.27 and the D 1618, these are extensions of this leg. And about 60% of the time with these patterns, the CD leg will extend to the 127, maybe close to it, maybe right to it, maybe a little beyond it. We never get just exact in trading. It'll extend to the 127 or extend to the 1618. So the 127 and 1618, again, these are Fibonacci extension ratios, and you can easily find them by taking the length of the AB leg and multiply it by 127 or 1618, add it to the low, add it to the low of the C, and that will give you the extension leg. And then same here for a buy pattern. So your retracement of B to C is moving to the upside, and then you have your final leg to the downside. So here you would take your A to B length, and then you would subtract it from this level here, and that will give you where the extension is, 127 or 1618. Now, here is a labeling example. So we're adding a little more detail now. So here's the lightning bolt of the A, B, C, D. And here is, here's in retracement. So the BC leg is your retracement leg. So you have the first swing and then you have a retracement. So there's only 1, 2, 3 legs. That's it. It's a simple pattern. And then a retracement, then the last leg, and then the B to C. You can also take the length of that and extend that to find where this pattern might complete. You want to find maybe some confluence of ratios in this area, and I'll show you an example of that in just a minute. So again, you would take the length of B to C, multiply it by your extension ratio, might be 127, 1618, and subtract it from your C point. On your sell pattern, then you would add it to that C point. Now here's just a couple of rules with it. Let me get those on there. The C must be below A. So here's the A, here's the C. So wherever the retracement is on here, so the B to C, this can be 382 retracement up to the 886 retracement. They can be the 1.0, in other words, it's equal to where the pattern starts. However, in classical technical analysis, that's like a double top or it'll be a double bottom. And so you have to, again, have some skills in being able to read the market environment, maybe some momentum, so you don't get caught in a adverse move. So it's not my favorite to see the 1.0. 886 is fine, but you got to consider a double top and double bottom type of scenario. And then over here, the D point must extend beyond B to be a valid ABCD. So here's the B to C leg. So here's B right here. Here's B right here. So you want to see that CD leg extend beyond the B point. If it doesn't, then it's not an ABCD pattern. It might be some other pattern that's forming. It could be a triangle that's forming, or it might be a range that's forming, but it's not going to be an ABCD pattern. Now, I recently heard somebody who was teaching these patterns that I don't want to put anyone down, but here's some examples of things that are going on out there, and this is one of the reasons why I've taken a considerable amount of time to develop these courses so that people learn this information correctly, and also the history of it. It's important to know, who did what. It's like I mentioned, Larry Pesavento, he's the guy that did this. He's the guy that named the butterfly pattern. If other critters are named, it's, they're just variations of these same patterns that Larry presented to us. But this other very young trader, only a couple years experience in teaching these patterns, said that he doesn't spend any time. He told people don't spend much time on the ABCD pattern because it's just that it's very simple. So I thought, wait a minute. That's not true. There's variations of this pattern that you must know about. The warning signs, you must know what those are. Different market conditions, you must know what those are. And in one of my courses is a 12-hour course. You can check it out on my website if you like. But in that course, I have 4 full sections just on this pattern to make sure that traders know it inside and out, and they can get onto price charts and be able to recognize it correctly. One of the larger um, errors that I see traders making when I work with them one-on-one is when I check the pattern recognition is that there's errors in it. And that's okay. That's what I'm there for. I'm there to help them with that. But in real life trading, if you're trading and not correctly identifying a pattern structure, you're not really trading anything. So if you have errors in that, that's going to be a problem. And extending problem of that is you don't know it's a problem because you didn't learn it correctly. So anyway, enough said on that. So here's something else on the variation. So that CD leg can extend, as I mentioned, to that 127, 1618. There's also the 0.77 in there. So we get that extension on either the buy or the sell pattern. So here's some of the tips on that here. And slopes and angles, the proportion are important as well. So here's an example on a price chart, Forex market. The Forex markets, those are great markets for these types of patterns. They form on a very, very regular basis. The S&P 500 as well. Intraday charts are great for these patterns. They're very repetitive. So you can see this one came to the 1.0 and had a nice bounce off of it. Here's a chart where we look at some proportions that are forming. This is the Gartley pattern. So what makes it a Gartley? Well, the ABCD is contained within a previous swing. So you see this high to low, there's the previous swing, then it forms this ABCD sell pattern on that retracement. And here we have a confluence of ratios. We have a 0.50 retracement, and we have a 1.27 using this swing here. So we had a swing to the upside, it completed, another leg to the downside. So we take this high and we can take the extension, the 127, and we have the C to D leg coming in right, right here. So we have a number of ratios coming in at the same place. Now, not only do we have this ratio here, but the C to D leg is also the 127 on that as well. So there's a lot going on in this price area. So let's look at a couple of chart examples. Then we're going to go to my charts and look at some current examples. So this chart of Disney, this chart had a big warning pattern here, 1, 2, 3 drive to the top pattern. The market started to decline. And then here some retracement pattern. So here's ABCD sell. That's a Gartley pattern. Then it forms a bigger ABCD sell. These are both Gartley patterns. This swing is contained within this previous swing. This ABCD is within this one here. But notice how we can, add in some classical technical analysis, and we can add a trend line in to here. We can see that the price comes down and tests it, rallies back up again. We have a gap to the downside here. The price gaps below, back up. We can start to draw horizontal trend lines, and you can see how the price is just clustering around that trend line, and then gap to the upside. That was a fake out move, and then big gap to the downside. So from there, here's an A. Sometimes I use this chart and have people fill it in, but I'll do it. A, B, C, D sell, so that would be a Gartley. because it's contained within that previous swing. So if you want to practice these, you go to your charts and you find swings like this and draw in, get the labeling in there as well. Then, big decline on here. See the small A, B, C, D? See how that CD is extending beyond that last swing here to the upside where the A started? Well, that makes it a butterfly. So that's the difference between the Gartley and a butterfly. A Gartley pattern has the A, B, C, D contained within a previous swing. What we showed here, this example, even this example is contained within that swing. Notice how the CD extends beyond that point. So that makes it a butterfly reversal pattern. Okay, so let's take a look now on this chart. So Funko, butterfly cell patterns over here on the left, yet a strong trending move to the upside. Now this butterfly cell pattern, ABCD, extending beyond the X point to the 127 extension. Strong move to the downside, and then market goes into range. So we have the three trends here. We have the uptrend, sideways trend, and we have downtrend, on this chart. That's it. That's all the market does. That's it. So we can learn to recognize market environments and be able to apply or trading tactics to different market environments. That's going to give you an edge. You want to be on the right side of the market. And there's different clues that you can learn to do that. Okay, so here, after the rally to the upside, you can see another butterfly pattern form. So notice the A, B, C, the D. Notice how that's extending above that X, the previous swing. That makes it a butterfly pattern, and the market reverses to the downside again. So let's take a look at this American Express chart. And we see a succession of butterfly cell patterns. These are known as reversal patterns. They don't always reverse the first time, but when you start to see a succession of them, especially combined with some other tools, they can be foretelling an important market turn. So in this case, the first butterfly pattern got a nice move to the downside, then rallied up again. There's an A, B, C, D cell, retracement, and that formed the last leg of this larger butterfly. So this would be the X point, A, B, C, and an extension on the C to D leg. So X to A extension is 1, 2, 7. Notice how this X to A extension, 1.414, but notice how that starts to form that natural trend line there. And that's a lot of times you can find a trend line by using extension ratios like that. So this was preceded the bear market in late 2021, 2022, American Express. So a big decline on that first move down. Retracement, it looks like an 886 retracement, last chance fib retracement, XA retrace, another move down, move up, another leg to the downside. Notice how it comes down, finds support here, rallies up, then breaks the support back up. So lots of different patterns within this, but I wanted to point out the butterfly pattern so you can really understand it. Important structure, A, B, C, D. The CD extends beyond the X point. Okay, let's take a look now at this SPX chart again from the highs before the bear market started in 2022. Butterfly cell pattern here. Notice the trend line, a break of the trend line, classic technical analysis coming back up, retesting that breakout point, big decline, another retest up here at resistance, really big decline. Well, eventually the market made a large ABCD. So here's the 1.0. And this is something that happens sometimes with these patterns. So you have the 1.0 where the legs are equal. It's getting a little bit past that. That's, not uncommon with these patterns. Got a nice rally to the upside, but then look at this decline. Formed a classical technical analysis, little triangle here, and then broke to the downside with a big gap, and down. But here's the 1.27 extension of the C to D leg. The market finds support, rallies, and forms a Gartley pattern. So these patterns that I'm showing you, I hope you're maybe starting to see, the risk on these patterns can be very, very low. In other words, like the butterfly pattern, when you know how to create a trade plan for entry with these, you can use the extension, the C to D legs with these patterns. There's very low risk here because you don't have to place a stop much further than where the pattern starts to turn from. And sometimes it will go like this, sometimes it'll just turn around and keep going, but you have a small amount of risk. But you want to be looking for capturing large moves like this. Again, you're not always going to get them, but over time you'll get enough of them that it's worth your time. And the Gartley pattern is a retest pattern of a high or a low, in this case a low, and so that also offers a good risk to reward ratio on these patterns. The market then rallied to the upside, and look at the extension from this previous swing high to low. It was a 127 into a 0.707 retracement, and there was some other resistance in price using classical technical analysis that could also be lined up with that. So let's look at a couple current examples of what we've talked about today. And I want to really illustrate something with these patterns. I've been talking about, the low risk reward. So let's take a look at that. And also, you have to take into account when you're using especially butterfly patterns, what the sentiment is around you. So if we take NIO as an example, so back in last spring, nobody was talking about this. It was, nobody was talking about it. It was just drifting lower, lower, lower. It wasn't really on the radar out there in the public news, chat rooms, etc. So butterfly pattern forms down here, and it consolidates for a little bit, even does a little fake move to the downside, almost hits that 127 from this swing low to here, and then starts to move to the upside. Well, there's some classical technical analysis patterns that we could also employ here, but the lowest entry was right here at the completion of that butterfly pattern. So again, that offers the trader a very low risk entry point. So with some patience, we see the market continuing to the upside. This trend line here, comes to the upside, finds some resistance from previous resistance, hovers around there, and then breaks through it. Well, up, again, this had not been in the news when all this was going on, and that's a very common occurrence. So you cannot wait until you hear everybody's talking about it, because this is what happens. Now it was in the news up here. I started seeing it like everywhere at the top of lists, and so this is what happened when everybody is hearing about it, and then it just collapses again. So it's like, do you want to be the trader here? Or do you want to be the trader here trying to follow chat rooms? It's not going to be a profitable strategy for you. All right, here's another one, Apple. So Apple, it's been a popular stock forever, for a long, long time. But here's some longer term trend lines coming back. 2020, here is a butterfly sell pattern. In Apple early 2020, all these sell patterns were forming on Apple. Anyway, we'll kind of fast forward. So back here in late December 2022, and everything was still looking very bearish. People were still bearish. Get this big ABCD buy pattern. and you get this butterfly buy pattern right into the same place, and then the market starts to move up again. There wasn't a lot of talk on Apple, not on the bullish side anyway, and you can see the big price trend to the upside, and then it stalls again. So this trend line is coming from back here across this high and extended forward. So you can see the price starting to stall around that that trend line. Uh, we could scale down to a smaller time frame and find some selling patterns right in here. You see the gap. Notice how it's holding this trend line here. Well, right now it's formed this extension on the CD leg of this ABCD back into this gap area. So my expectation, I don't know what price will do, but my expectation is that we may see another retracement to the downside on Apple. These lows are going to be very important for Apple to hold. And then in order for Apple to really move to the upside again, it's got to be able to get above these highs. But this is a short-term sell pattern. The 1618 is right into that gap area. And risk on a setup like this can be placed just above that trend line. So there's an example of a combination of classical technical analysis and the harmonic patterns. I mentioned how the S&P 500, these patterns form, on a very regular basis on the S&P 500. So let's look at a couple examples on an intraday chart. So this is a intraday, I think this is a 60-minute chart, intraday. So up here, back in late July, here is a butterfly sell pattern. You can draw this trend line across here. The market declined from it, and then a little rally back up. It formed a sideways range. Remember, up, down, sideways. That's it. That's all it does. And then gapped below it, gapped below the support. And then notice here, right here, retest of that trend line that is broken. So what was once support is now resistance. We can see an ABCD sell pattern forming right into a resistance area. So this allows the trader, first of all, you can monitor this pattern as that CBC leg starts to turn to the upside, and traders can plan the trade and assess the risk in the trade. Then from there, the market declines. Here's another ABCD pattern right here. I'm actually going to draw it in this way. It has the formation of a butterfly pattern because your CD is extending above. However, it's still within this swing here. So I would really consider it a Gartley pattern. We can use this extension as another ratio to help with entry and managing risk. So now the market had found support. These dashed lines had been on my chart and extended out for quite some time. I tend to put those on my charts and keep them on there so I don't forget about them. And here's the ABCD pattern. So we talked about the symmetry a little bit. Notice when it gets to the D1.0, it's not a very symmetrical pattern. We have quite a difference in the slope of the A to B than we do in the C to D. This is a much steeper. So that tells us the market is likely to get to one of these extension ratios, maybe a bit higher than that, which it did in this case. So you want to really be able to study the symmetry of those two legs. This is why it's important to know the ABCD pattern and why I've got it in 4 sections on my longer course. So then we form a 1, 2, 3 drive to the 3 drive pattern to the top, and again here's a 707 retracement, and that's coming in to, remember, here's our previous support that was once broken. Now it's resistance. So that came back in, tested that, and we've got a move to the downside. So we'll see how much of retracement this can get. These are going to be very important lows to watch down here where the pattern started. That's a support area. Retested it on an 886 retracement. We'll just show that to you real quick. So notice how that caught that on the 886 retracement. The market reversed from there. We had a consolidation range, and then the market broke out to the upside. So there's, I think, a good example of a lot of different elements going on, but all very tradable and all, tools to help the trader manage trades, assess risk in trades, and entry points. Coin is one that we've been following for quite a while on a subscription service that I have that I actually just ended it, and then also with some students that I work with. But it had gone, it had a big decline to the downside, and then along with a lot of the cryptocurrencies, and then went into this big range. Here's the butterfly buy pattern down at these lows, a rally to the upside. We see another, here's an A, B, C, D pattern here, right here. And then the market rallied up there sideways, retest, and then strong move to the upside. Well, this level right here, where these highs were right here in this gap fill, the market was able to have one strong close, but that was about it. I mean, then it just went sideways, kind of fake move to the upside, and then down. Very extended kind of A, B, C, D. If you notice this B to C leg, it's very, very sideways, and sometimes that's not the best of these patterns. So what's next for this? Well, it's still in a big range, and these are the highs that have to be exceeded. I think when they do get exceeded, it's going to be a very strong move to the upside. Conversely, these lows right here, market's got to hold these lows on a test. It might just kind of slip through and come back up. That's okay. But you start to see strong closes below it, and that's likely to be a strong move to the downside. So right now it's just back into the range. It held this 0.618 retracement, had a rally to the upside. Pink dash line is showing us some resistance it needs to get back up through. So I hope you found those examples helpful. And I'd like to, for a few minutes now, just kind of show you some of the materials that you can study. And as I mentioned, I've been in the markets for a long time now. I've had some good mentors that helped me on the path. But in the long run, in the end, you've got to get in there and do the work yourself. I mentioned you're not likely going to make money from just being in someone's chat room and trying to follow trade signals. It's a very difficult thing to do because your mindset is different from theirs. And if you don't really know and understand, what the whole system is about, you're never going to have the confidence to take every signal that comes along. And that's something that's very important in trading. So, some of the traders that I've helped over the years are kind enough to send me, some testimonials that, tell me how I've helped them. And I'm very proud of that I've been able to help a lot of traders. It can be a very, very tough business. So here's just a few of those, but I'd like to show you. This is the newest course I have, Trading Mastery Harmonic Patterns combined with classical technical analysis. And I did a series of workshops over a period of 6 months, and they were recorded. And the materials were in a methodical order. So we started with pattern setups and the harmonics and went through those in detail. And that one was 1 hour and 14 minutes. And then the second workshop. Second workshop is 1 hour and 18 minutes, and it's on support and resistance. And this is showing you that the power of combining those harmonic patterns with the classical technical analysis, where this really fuses together. And I showed you just a few examples on the charts now. But traders using the harmonic patterns are going to really benefit from this video on the support and resistance. I teach several methods of identifying support and resistance. And again, traders are going to uh, really kind of boost their trading skills with that one. The next workshop was on ranges versus trends. So I was talking about market environments today. And so this is a very important concept to understand and learn with price behavior, price action. Not only, most of the things we learn are in hindsight, but you've got to learn to be able to identify these things in foresight to anticipate a market's move up or down, or understand when you see the signs that it is moving strongly in one direction, that that's the side of the market to be on. One thing I know from my own personal experience and working with many traders is that when you get caught on the wrong side of the market, sometimes it's from a bias. So you keep trading the wrong side of the market and you're taking loss after loss after loss. Well, I hope to eliminate that for you with this particular workshop to learn the differences between ranges and trends, and also the footprints of when price is coming out of a range, because oftentimes it will be in a trending type of a price move. And then we come to workshop for reversal patterns. So if you can learn the footprints of price reversal from either down to up or up to down, you are really going to gain skills that are going to increase your gains, your profits, and reduce your losses. So those are always things we're striving to do in our trading. So I teach you 6 reversal patterns in this section, and then I walk you through examples, charts step by step, and we work with the butterfly reversal pattern, and I show you what ending swings are. Those are important as well to learn. Then from there, we move on to working with multiple time frames and the fractal nature of price. So the fractal nature of price is really referring to that if you're on a weekly chart, what you see on price data patterns is fractal. You'll be able to see that on a 5-minute chart. So price has the same characteristics on a longer term chart as it does on a short term chart, and that's important to understand. Multiple time frames can be an extremely powerful tool for traders. So I walk you through how to implement multiple time frames. And then the 6th workshop is on retracement entries. And I think that there are only a couple specific market conditions that are going to favor retracement entries. I don't favor using just a Fibonacci retracement level just because it's a Fibonacci retracement level. There must be more there in order to put the probabilities on your side. And so that's what we talk about with this particular topic. And then also I talk about what are hidden errors. And these are errors that traders really don't know that they're making, but they're having a very large impact on their bottom line. So I think it's important for you to understand what those are. And I am very confident that this is going to increase your trading skills and your understanding of market behavior, and is going to be able to implement it into any trading style that you choose to have. But you do have to learn to identify higher probability trade setups. So for this special, it's going to include that course that we just walked through. That's 7.5 hours. And then I'm also going to include the Introduction to Trading with Pattern Recognition course, which is 3.5 hours. And this is going to walk you through all of the details of the AB equals CD pattern, the Gartley pattern, the butterfly pattern, the 3-drive pattern that we saw an example of on one of our charts that we looked at today. So you will have all of the information you need to have the correct pattern structures, and then you can practice those on your charts. So both of these courses together are, usually $449, $450, but for the presentation price, $299, and that will expire September 11th. So you can go to my website, and you can just go to the Trading Mastery course. There'll be a little, it's under trading courses. Harmonic patterns was classical technical analysis. Don't worry about this one. Just sign up on this one, and then put the coupon code in at checkout, and that will give you this price. And then I will sign you up. When I see your receipt come through, I will get you all signed up for the Introduction to Trading with Pattern Recognition, and you'll also get a copy of my book. If you have any questions, just email me, and I'm happy to answer any questions if I can. And thank you for watching this presentation, and best wishes for successful trading.